Last week we discussed information for capital budgeting. Today what we are going to do is we are going to discuss the balance part of the chapter. We discuss the meaning of capital budgeting and capital budgeting process, and also the difference between independent and dependent projects, mutual exclusive projects, and independent. Mutual exclusive means if there are alternatives, when you accept one, you have to give up all other alternatives. So I gave you example also. Independent projects means projects are independent. You can accept all the projects if the funding is available. Then we discussed the techniques of capital budgeting. Basically, we discussed the discounted cash flow technique, NPV, IRR, and profitability index. Then we discussed the non-cash flow discounted techniques, accounting rate of return, and the payback method. So all these concepts we discussed. Then we really stop at what you call accounting rate of return. Also we discuss the other issues in capital expenditure analysis where we stop. So where cash flows projections are uncertain, many managers may increase the required rate of return, use sensitivity analysis. We discussed the sensitivity analysis also, I think I can remember. Potential conflicts between the criteria for evaluating individual projects and those used to evaluate overall performance of management. So here the idea is when divisional managers are really evaluate based on financial performance, based on profit figure, and if your projects are evaluated based on discounted cash flow techniques, then what happens is there would be a conflict between criteria for the project evaluation and the evaluation of the managers, because manager is focusing always profit maximization projects, profit increasing projects, whereas project evaluation criteria is focusing on NPV criteria. So thereby there would be a conflict. Managers may always try to increase the profit. Increasing profit is not a big thing. You can suppose if your performance, suppose as a CEO, if board is really giving you the targets, okay, this year profit has to be 10 million or 10 billion or whatever, then your target is to achieve that profit. So what you can do is you can show the profit by by engaging organizational politics inside your organization. You may talk to your accountant and you ask, okay, you prepare the financial statement, but reduce the depreciation. If you reduce the depreciation amount, you can increase the profit. So if you really unaccounted certain expenses, again you can increase the profit. Or if you accounted for next year income for this year, if you are taking next year sales into this year, of course you can increase the profit. Everything depends on the accountant and the auditors. I think I can remember when Champika Ranawaka was in the Ministry of Electricity, Energy sector, the electricity board, he had a conference and press conference. He told that okay, after many years in the history, first time electricity board made a profit. So you can make profit, but what happened was that during that case, for that case, the machineries, plants which belongs to the electricity board, they didn't depreciate. So thereby automatically when you provide low depreciation, automatically profit will be high. So thereby there is a difference between profit and cash flow. I think when you are lending, when you are evaluating lending projects or the project proposal to lend, as a banker or the credit officer, you may much more put your attention on the cash flow, not the profit, because cash flow is always, you know, more reliable than the profit figure. Profit is a kind of things you calculated. It's a kind of thing you generate. It's artificial. Profit is artificial, but cash flow is not artificial. Now, my account balance, my current account balance, I can't, you know, manipulate. My current account balance is the balance. So thereby, the cash flows I received for my business will reflect in my current account. So thereby, cash flow is more reliable than the profit figure. What I want to communicate to you is that if your measurements, performance of the manager here is really, you know, based on profit or the divisional profit, manager may work towards increasing the profit. Like, you know, when you think about this, the education system, people are trying to get the, you know, 9 A's, 3 A's, batch top. They are just motivated because their performance is measured in terms of, you know, marks. So we don't appreciate other, you know, qualities, teamwork, other different skills, you know, movements with society, you know, interact with the society, that capability. Those type of things are not measured. So thereby, so it depends. Always we motivate according to our performance evaluating criteria. So here for the project evaluation, if you focus on DFC technique, that is NPV, and for the manager evaluation, if you focus on profit, obviously there will be a complete managers will encourage really profit projects, not the NPV positive projects. That's the idea here. Then the income tax and capital expenditure analysis. In profit-seeking enterprise, income tax are usually payable. Taxation payment and tax deductions must be considered in cash flows and used in capital expenditure proposals. After cash flows after all the tax implications have been taken into account. The idea here is when you evaluate a project proposal based on discounted cash flow techniques, and when you calculate the profit, always you take the profit or the cash flow after tax. That's the idea. You take the cash flow after tax, not the before tax. I know that most of you all may not familiar with the taxation, but it's not a big thing. Just income tax rate we are focusing here. Tax effect on increase in sales. Consider incremental revenue and cost arising from a capital expenditure decision. Incremental sales revenue less cost of goods sold. CGS means cost of goods sold. Cost of goods sold. That's the CGS. Into 1 minus tax rate. If the tax rate is 10%, 1 minus tax is 90%. Something like that. Tax effects, additional expenses, incremental expenses, of course. 1 minus tax, then again you get the after tax information. Non-cash expenses like depreciation are not cash flow, but can produce tax savings, hence may reduce cash flows. Some cash flows do not appear on the other income statement same period in which they occur. Some cash flows are not okay. Depreciations and cash flows. This is about Australian method, but in Sri Lankan method also we use the straight line method. The straight line method means, you know, just divide the total cost by the lifetime. I think last time I did one example. Diminution means, I think you can remember the loan story, reducing balance. you always reduce the already settled capital amount from your loan balance, something like that. So from the depreciation also, when you calculate depreciation based on diminution value, we reduce the already provided depreciations. That's how diminution. The method used will affect the after-tax cash flow projection. Impact of capital expenditure projections. Cash flows will result from taxation, depreciation, not accounting for depreciations. So other cash flows issues arising from profit or losses, disposal assets have tax effects and therefore after-tax cash flow. Carrying amount is an asset's acquisition cost minus the accumulated depreciations. Carrying amount is the, always the assets minus cost minus accumulation. Investment allowances also affect the cash flows in the year of purchase and assets. Working capital may increase due to the higher accounts receivable inventory needed to support capital investment projects, and these are cash flows. Working capital. Investment in advanced technologies, of course, investment in advanced technologies, basically there we focus on high-tech projects like, when you talk about projects like Nissan, Toyota, helicopter manufacturing, institutes, high technology oriented, what you call computer aided manufacturing environment, high tech where robots are really working as laborers. High technology projects may yield negative NPV even when managers know the projects will provide a competitive edge. Because high technology needs initially very high investment. But cash flows are, the benefits what you are getting from this high technology, it takes time. So thereby, when you evaluate projects for 5 years, 10 years, 6 years, of course, you are not considering cash flows after that period. So thereby, high technology projects may end up with negative NPV projects. Difficult to quantify strategic impact on relevant benefits and costs arising from investing in advanced technologies. When the technology advance, so very difficult to quantify all the benefits. Strategic implication for here the technology means not only the IT. Even suppose you change your normal road to highways. When you construct highways, flyovers, the technology is different. So thereby you need to do huge development projects. When you undertake these development projects, there are side effects, there are benefits, unexpected benefits. Very difficult to quantify all these things. That's why it says here. Strategic implication for such investment, and there are strategic implications, maybe your competition, you maybe due to this high technology oriented projects, you may have a position to create a good picture, so thereby you may attract customers for other businesses as well, and you are being better off as a group. You are being better off if you accept a particular high tech projects. I think I can remember the Sampak Bank when they introduced the ATM machine at that time, those days. So they got that advantage, being a first mover to the ATM machine. So that's what the strategic implications. So likewise, you may have strategic implication when you go into first by using new technology. Not only the IT, it's technology. Intangible benefit derived from the investment. So there may be intangible benefits as well. Post completion audits of capital expenditure decisions. Review past capital expenditure and project by analyzing cash flows generated and comparing with the expected cash flows. So this is the implementation monitoring part. Post completion is the monitoring part. I think you can remember we discussed 3 parts of the capital budgeting: planning stage, implementation stage, and post completion, that is monitoring part. Here the monitoring part help managers to undertake periodic assessment of outcomes, make adjustment where necessary, control cash flows fluctuations, assess rewards for those involved, identify underperforming projects. This is the results of the feedback. So you may, you may assess from period to period. You may compare your cash flow predictions with the actual cash flows. Then again you can think about what will happen to this project ultimate results. Make adjustment where necessary. You can do necessary adjustments, maybe modification, maybe downsize, maybe new additional investments, maybe bringing new technology, latest technology to the current project, etc. Control cash flow fluctuations. You look at the cash flows and assess rewards for the involved. So those who work well and those who do more commitment to the projects and those who take the risk, high risk, you may rewards accordingly. Identify underperforming projects. So you during this post completion projects, you may identify, if there are 5 projects, you may identify number 1 is not performing as well. What shall we do? Likewise, identifying underperforming projects and etc. The limitation of conventional capital expenditure analysis: use unrealistic status quo. Assume that current cash flows will be maintained if the project does not go ahead. Need to compare the cash flows of the new proposals, education, reductions. Those are the 2 unrealistic status quo. Then hurdle rates may be too high and time horizon may to be short. So those are the limitations. Conventional cash flow, difficult in gaining approval for large projects. Advanced technologies may entail greater uncertainty. Some benefits are difficult to quantify. Example, synergy. So these are the limitation of projects. So limitation of projects under use of unrealistic status quo. That is one thing. Hurdle rates may be too high or too low. Certain hurdle rates mean discount rate. The time horizon may be too shortened, maybe 5-year period, 3-year period, 4 years period. So thereby you are evaluating, you are considering only the cash flows which are related to that time period. But generally a project may generate cash flows for indefinite period in certain cases. Think about your equipment you use in your business, or think about your motor vehicle. Then think about the assets you are currently used. Even though you predict your laptop, you may predict the laptop duration is 3 years, but you know that this laptop you have been using more than 3 years, maybe 5 years, maybe 6 years. But initially we know that the normal estimation life of the laptop is 3 years, but practically it's not the case. Similarly, even though we predict projects for 5 years, 6 years, 7 years, but actual duration is not that. So thereby that matter is not being considered. Then during difficulty in gaining approval for large projects. So very difficult to get large projects, because those are in certain projects linked with the society. Social issues are there, cultural issues are there. I can remember this certain hotels in Dabul area. Those projects, they were unable to get approval. It was a big difficult. So likewise, certain projects get very difficult to get approval, because different stakeholders may have different views and different power. So thereby power struggle between different stakeholders come into the scene. So thereby powerful people may tend to extend the approval. Maybe they resist, something like that. Difficult to gain approval for the law. I think classic example is the recent case is the UNP government, Japan government. They tried to introduce what do you call particular technology device to school children, but they were unable to get this project implemented. Whether it's good or bad, what I'm trying to tell you is that the getting approval for huge investment project, very difficult. It will take longer time. Even private sector, the same story. For example, if you look at this Harishchandra Mills, I don't think that you can get approval for a good new projects because their culture is different. The board. Advanced technologies may entail greater uncertainty about operating cash flows when the technology involved. When technology, especially the IT, information technology, involved, the lifetime is becoming product life cycle is becoming less and less. So uncertainty is there. We don't know what will happen tomorrow, what technology comes in tomorrow. So thereby there is a huge high level of uncertainty about the operating cash flow. Some benefits that are difficult to quantify, even you think about this COVID case. Due to COVID case, certain businesses, the cash flow really, reduce. For example, this banking sector, finance sector, with the government decisions, no, with regard to loan installment and the fine money interest and all that, they are cash flows. Some benefits that are difficult to quantify may exclude from the analysis synergistic effect of multiple capital expenditure proposals. Synergies means really it's the idea is when you add 1 plus 1, obviously answer is 2. The synergy means 1 plus 1 is more than 2. Meaning is that when we work alone, the results, and when we work as a team, the results, two different. Teamwork results is more powerful, more productive than the individual work. So thereby synergistic effect, multiple capital expenditure proposals not considered. When you accept different kind of projects. Now, for example, classic example in Sri Lankan government during the Mahinda Rajapaksa's regime. So you see that they started different projects, the highway projects, hotel projects, construction projects, IT projects, e-governance projects. So all these projects, when you combine together, there is a synergy. But this synergy is not being considered when you quantify the cash flows of the particular projects. Greater flexibility in production process. We don't consider the flexibility, and shorter life cycle reduce the lead time. Shorter life cycle means just because of the dynamic nature of the environment, whatever the product, getting lifetime is very short. And also reduce lead time. Reduce lead time means time taken to convert the product into cash, from production to sales. That lead time, maybe procurement lead time. You may talk about lead time in different places, different scenarios. Purchasing or the procurement lead time. Now I can remember the gas story. Laugh gas. The chairman told that okay, within 1 week, the new gas, the laugh gas, yellow one, will be available. So thereby, procurement lead time is 1 week. You bring the gas from you import it and you fill it and you distribute to the customers. So lead time is 1 week. That is procurement and distribution. So you may talk about the production lead time. Better to reduce always the lead time. Then you can save the administrative cost. So thereby, it is very very rare. You consider all these factors. Reduction of non-value added cost even. That is with that, of course, the project capital appraisal project is over. So just to elaborate one particular example, can I just give you a what do you call, shall we do a small example just to understand what we discuss. Suppose you have a project period is 1, 2, 3, so I take 4 years project. The initial investment means the initial one. The initially, to start the investment, we will see that we need we see that we need 200 billion. All figures are billion. Okay, 200 billion. So at the end of the project period, say this is a particular machine or whatever, the project may realize the initial investment. This is negative, because you are making the investment. You are making the investment. This is initial investment. You may recover 50,000. So you will realize initially this is minus. This is minus, and this is positive. This is minus, this is positive. Then income from this, the cash flows, cash inflows, say cash inflows. Cash inflows means by performing this project, you get cash inflows. Here 50 in the first year. Here it is 60. Here it is 100. Here it is again 50. That is the cash flow. Cash inflow. Suppose operating cost. Operating cost means the expenses. I would say the cash outflow, the first. Cost is, of course, say 10, 30, okay, 650, and 10. So I think I have to increase a little bit just to get just to convince you. 80. Here also we'll say 110. Don't worry, just figures I put. So these are negative cash flows. Okay, so thereby you have to put it in minus within, that is the minus figure. This is also minus. This is minus. This is minus. That is the cost or the cash outflow. And also, when you start a project, you need what you call working capital. You can't just do a project. You need the working capital. So working capital investment, like suppose you are starting a daily shop, normal supermarket. When you start a supermarket, you have to bring some goods. Even your home, a kitchen, you may have working capital. Your daily needs you have sugar, flour, and other things you may have stocks. So thereby working capital investment you have to invest at the beginning, not the end of the first year. So thereby normally working capital, say 30 million. Working capital 30 million. Working capital 30 million. Uh, I have small problem data. I'll come back. Okay. Working capital 30, and here it is. When you increase working capital at the beginning, normally you will get it back. So thereby working capital investment is again minus. Uh, uh, Again minus. Now, certain cases, you may get the working capital back when the project is over, as it is. If you say that you get 30 back in certain cases, but due to certain factors, you may get back the working capital realized less than that amount. We'll assume that okay, we are getting only half of the working capital invested at the end of the project. So I think we discussed this one in our discussion. So if I am going back to that slide again, can you remember here somewhere here? We discussed working capital, not after tax item, depreciation. Here. Working capital may increase the due to higher accounts of receivable, inventory needs, supports capital investment projects, and these are cash outflows. Here, this one, the working capital, right? Okay. So thereby you are investing here working capital, and you are getting it here. But when you expand the business, you may increase the working capital also. When you expand the business, you may increase the working capital also. Working capital. So, what I want to communicate to you is that by taking this few data, the pattern of cash flow. Now you can describe this particular data set by using a paragraph. Initial investment so much, so you are going to recover this much 50, and the in cash flows in the first year so much, and the cost going to be incurred so much. Likewise, and working capital investment is so much. Here it is so much. So you get. So you will see that. This is the cash flow statement, but these particular income, when you do a business, you have to pay tax, and for this also you have to pay the tax. It's tax saving because those are expenses. So thereby, what you can do is you can put the tax on cash flow, tax on cash flow. Tax on cash flow. So tax on cash inflow, of course, you can put the tax in cash inflow, and also tax on cash outflow. Tax on cash, taxing cash inflow and taxing cash outflow. Okay, taxing cash inflow, taxing cash outflow. Inflow is this, outflow is this. Okay, cash inflow and cash outflow. So we have to find out the tax rate. Assume the tax rate is we'll say tax rate is 40%. Tax rate is 40%. If the tax rate is 40%, so we are just calculating 40% of this. So 40% of this means the 80, right, multiplied by 40%, right, which is minus. That is a tax. So when you earn 80 rupees, you have to pay the tax 30 rupees. So likewise, you can do the taxation on each element. 110න් 140, 100න් 140, 50න් 140. That is the payment. But for the tax outflow, it's a tax, of course, saving, but you are calculating 40%. There is no change. You get the tax saving. So thereby here it's of course yes, it has to be a positive figure, because for positive 4, here what is positive 12, here positive 20, here it is again positive 4. That means by this amount your tax payment will be reduced. For the income you are making, you have to pay the tax. That is of course 32, 44, 40 and 20. And for the cost, there is a tax saving. Tax on cash flow, 4, 12, 20. So thereby, after considering all these, you can get the total. You can get the total. So how do you get the total? I think easily you can get the total. So when you get that total...
Excuse me, sir.
Yes. Yes.
So could you please explain again, how did you calculate this tax on cash outflow thing?
Again, it is 40% out of 10. Because this 10 is, you are making, it's going out from your business, so thereby government encouraging. Government is giving that benefit to you because you are spending. In other words, when you earn 80, you spend 10. So thereby your net income would be 70. So thereby you have to pay tax on 70, not from 80. So that's why what I did it separately. I pay tax on 80 rupees, 32 rupees. That is 30 rupees you are paying on income, and there is a saving. You are not paying tax. You will deduct your tax payment by 4 rupees. Altogether, your total tax payment would be 28. Here 44 minus 12. So basically we put the 40%, you apply the 40% on cash inflow and you apply the 40% on cash outflow. For cash inflow, of course, it's a payment with regard to tax. For cash expenses, it's a tax saving. So thereby you are putting as a positive figure. Here 4, 12, 20, 4, you put as a positive figure. So what is the net cash flow is this. What is your net cash flow? Altogether this. So what you can do is, that is net cash flow, and then you have to find out your discount rate. Suppose your discount rate is 10%. So I'm just taking it, I'm telling you 10%. If the discount rate is 10%, so what you can do is, you can just 1 divide by 1 plus 1 0, you know the formula, and power, of course, Zero, I am putting it as 0. You know, answer should be 1. Of course, here the data, you get it. Based on your second table, you may agree with me these factors. You may have the second table. And now you can, you know the factors, and you can now discount. The process of discounting. Once you discount it, you get the present value. So we will call it present value. How do you get the present value? This you multiply by the factor. You get the present value. Multiplied by the factor. Whatever. 0. Multiplied by 1. Yes, 230. Yeah. So thereby, so you get the present value now. So the present value is there. Now you have to calculate the NPV. How do you get the NPV? Is the total of present value and discounted future cash flows. So when you get the total of all these present value figures, you get the NPV. NPV here is negative 68.82 billion. Asanna billion hatata negative. So thereby we will reject this project. Why we are rejecting this project? Because NPV is negative. We are not accepting based on project evaluation technique. We are not accepting the project. We are rejecting the project. Is it clear? Why we are now, suppose this is the project which is going to be started by Bank of Ceylon. Say they are going to install a new machinery, new deposit machines to their system for all the branch. So they have estimated the investment of all these so much and cash benefits or whatever the savings and all that. Anyway, net cash flows this much. So their project is rejected. That's the idea. Why we are rejecting this project? Because suppose your market value of a project. So now you know whatever the business they're listed in the stock market, so they have their own market. Suppose this is Sampath Bank. If the Sampath Bank market share is say market share is I will say easy figure 200. Market share price per market share is 200 today. But if you go to the stock exchange, you can find out the market price. We'll just take one simple example. Per share 200 rupees. Today, if you have one share, you can sell it 200 rupees. That's the meaning of market price. Suppose it has 10,000 shares. Then what would be the value of the Sampath Bank? It has 10,000 shares. One share per 200. So thereby market value of the Sampath Bank or whatever the business we are focusing is really multiplied by this 200. This is 200 per share. So suppose we are getting it, you know the value, just multiply. And it is of course basically how much? 2 million. 2 million value. If you are going to buy Sampath Bank or whatever the bank, according to our data, price has to be 2 million based on the market price. Now, suppose you are going to implement a new project for that business. So you will see that the project value is now we'll assume this is 200 million, billion. Billion make a 200 billion ke. So if you are going to evaluate this new project and you see that okay, NPV is negative. Why we are rejecting the negative NPV? Because the current value will be reduced by 68. That's why we are rejecting. So thereby new value of the business, if you accept the project, new value of the business would be these two. මිලියන බිලියන 1932. කලින් අපි මිලියන බිලියන 200ක් කියලා කිව්වා. So thereby you will realize 1932 බෙදුවොත් දැන් කොටස් 10000න් කොටස් 10000න් අපිට තියෙන්නේ. You will see the market price share. එතකොට market price එක වෙනවා අතරම 193. That's why we are rejecting negative NPV projects. Why we reject negative NPV projects? Because if you accept all these projects, in case what happen is existing market will reduce, market value will reduce by that amount. Similarly, if the project is positive, we are accepting the project. Why we are accepting positive NPV projects? Because by that amount market value will be increases. So the other wording press conference look here. This is the case. We are going to accept we are going to start a project like this. Project profile is this, and the NPV so much. So this is the nature of the business. This is the mechanism process of implementation project. So then, if the project NPV is positive, tomorrow morning what happened? Tomorrow morning, once the press conference is over, tomorrow morning your share prices will increase by the NPV. That's why we are accepting positive NPV projects. So thereby there is a logic for accepting NPV positive and rejecting NPV negative projects. Why? We are rejecting the negative NPV project because by that amount our market price, our value of the business reduce. That's why financial terms, financial analysis, we reject the negative NPV projects. Is it clear? So with it, this is with tax example. Now this cash flow is after tax because we have already deduct the tax. That's why I told you in the slides above, just when I begin the lecture, I talk about the taxation. Taxation is this. So this is net cash flow after tax. So I think with that I conclude the capital budgeting session. So we discuss basically discounted cash flow techniques. Especially we discuss the NPV, IRR, and profitability index. And also we discuss the payback and the return on investment or the IRR. Today what we are going to do is we will be discussing today another session that is I think so what we are going to discuss is that's it. Cost volume profit analysis. I hope that you all can see. The cost volume profit analysis is not so far we have covered 3 chapters. So far we have covered 3 chapters. One is time value of money. Other one is weighted average cost of capital or WACC, cost of capital title. Third title what we discussed was capital expenditure of the investment proposal. All these 3 titles or the topics or the sessions involve discounting the present value, cash flow, converting future cash flows into present, and talking about rates, discount rates, and talking about different type of cash flows, annuity, lump sum, annuity general, annuity due, perpetuity, growing perpetuity, what we call beginning perpetuity due, perpetuity general, all those type of cash flows patterns we discuss, and all those patterns important when you discuss these three areas. Whatever the area, pattern of cash flow is important when you go into discount or compounding. There are four tables. I think you can remember: future value interest factor, present value interest factor, future value interest factor annuity, and present value interest factor annuity. There are four tables, and of course from this four table, the last two annuity factor table, of course you can talk about other way also, annuity due. So if you want to convert any factor, annuity factor into due annuity, what you have to do is you will multiply the factor by 1 plus interest or 1 plus discount rate. I think you can remember. Altogether, there are 6 basic formulas we discuss in those 3. So I see that what I will see that I will see these 3 sessions. There is a similarity. What is the similarity? We discuss about time value of money, discounting, compounding, etc. Okay, and always we focus a longer term cash flow period. So thereby decision was not short term. All the decision analysis focus data related to longer period. So longer period decision making techniques analysis were discussed in the first 3 sessions. Now of course cost volume profit analysis is a short term decision making techniques. Short term decision making techniques. So thereby when you are making a short term decision making, time value of money is not considered, ignored. Discounting story, factor story, present value factor, future value factor, those factors are not considering. So thereby we will just adding figures whatever the given. Is it clear? Okay. Cost volume profit analysis. There are the basic structure. What is CVP analysis? The break-even point. Then graphic CVP relations, target net profit, using the CVP analysis management decision, CVP analysis with multiple products, including income tax. Here also we discussed a little bit about tax, practical issues in CVP analysis, an activity-based approach to CVP analysis, financing planning. These are the areas we are going to discuss. CVP means cost, volume, profit. C cost, V volume, P profit. That is CVP. Cost, volume, profit analysis. So those are the areas what we are going to discuss under this what you call cost, volume, profit analysis. It's a short-term decision-making tool. Okay, first cost, volume, profit analysis, a technique used to determine the effect of changes in an organization's sales volume on its cost and revenue and profit. This is much more important when you are going to evaluate a project. Suppose a businessman is asking a loan. He is giving you the project proposal. So when you are evaluating this project proposal, for him to decide whether to give a not or loan, whether to give or not a particular borrowing or the finance facility. So you may evaluate the project proposal. When we are evaluating the project proposal, what you can do is, first thing, you can just look at the short-term decision making, short-term analysis, whether the business is short-term wise feasible. If the project is short-term wise not feasible, then there is a particular issue. Anyway, a technique used to determine the effect of changes in an organization's sales volume on its cost, revenue, and profit. So what do you mean by this? Sales volume means quantity. Quantity means maybe number products, hours, seats. So volume here means capacity in terms of not monetary terms, in terms of unit terms. Suppose you have a cinema. to make a particular show profitable, how many seats to be filled, how many tickets to be sold. Suppose you are organizing a film under your welfare society. So to make break even the project, how many tickets to be sold, how many incomes to be generated, how many sales to be made to become the project feasible. That's the idea. So thereby here we talk about the sales volume. Sales volume will have an impact on cost. Sales volume will have an impact on revenue. Sales volume will have an impact on profit. That's the idea. Sales volume will have an impact on uh, 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 profit, revenue, cost. So thereby, what is the independent variable and what is the dependent variable in the cost volume profit analysis? You have to understand in the cost volume profit analysis, sales volume, the capacity is independent. And cost and revenue profits figures are depend on sales volume. Are you clear what I'm telling? What I'm telling you here is that the sales volume is independent and cost revenue profits depends on basically sales volume. So thereby there is a independent dependent variables like like NPV analysis. We discuss dependent independent variables. NPV depends on so many variables. I think I highlighted that where you get independent dependent variable relationship, you can perform the sensitivity analysis. What variables more sensitive to this project going bad, going fail, making fail, etc. I think that's very clear. Sales volume can be used to profit seeking organization and also not profit, whatever the organizations where you have the volumes, cost, revenue, profit applicable, whether it's a service oriented organization, profit oriented organization, non-profit, NGO. You can even for a club, sport club, you can apply number of memberships to be offered to make your business project feasible. So you can calculate. Even when you are organizing a trip, suppose you are having a 20 days overseas trip. So how many people to get in to make your project profitable or just to cover up your expenses? That's cost volume profit analysis. Okay, then break-even point, the volume of sales where the total revenue and cost are equal, the operational break-even. So you may talk about a concept called break-even point. Break-even means your total revenue is equal with total cost. So whatever the quantity you generate at that quantity, if your sales revenue equal total cost, that quantity is called break-even. Break-even means no profit, no loss. You just cover up your all expenses by using your sales revenue. At that time, at that level of operating capacity or the level of production. Okay. At this level of sales is no profit or loss. Can be calculated for entire organization for individual projects. Of course, if data is applicable, you can calculate this data, the break-even, even for one product, even for total organization. It doesn't matter. Okay. Break-even formula. We have a formula. Break-even point is really fixed cost divided by unit contribution of margin. Other one is fixed cost divided by unit contribution margin ratio. That's how you calculate the break even. If you divide the fixed cost by unit contribution margin, you get the break even in units. If you divide the fixed cost by unit contribution margin ratio, you get the break even in sales unit. Is it clear? Okay, something like this. Suppose you are having a particular, say, uh, okay, say you are having a particular product, say product A, you are selling the product A, whatever, whether it may be a service even. Okay, your selling price would be, say, selling price is per unit 100 rupees. For the product, the variable cost, we call it unit variable cost, is 40 rupees. Unit variable cost is 40 rupees. Unit variable means when you produce, when you sell that particular unit, each product will cost 40 rupees. That's called variable. Okay. So likewise, if you sell 100 product, 1000 product or 100 products and 200 products, we can calculate the total sales. Here the total sales is how much? Yes, 10,000. Here the total sales is 200 into 100, so much. Here the total variable cost would be for 4,000. Here, of course, binduai atta ini, atta, yes, 8,000. That is the idea. Is it clear? So, selling price, unit variable. So, when you deduct the unit price, unit selling price from the variable cost, you call contribution. A technical word, contribution. What is the contribution per unit? Here, you are making 100 rupees sales, 1 unit. When you sell 1 unit, your direct cost, variable cost would be 40. So thereby you have a 60 rupees contribution. This is unit contribution because it is for 1 unit. But here you can get the same thing, same answer, but that is not the unit contribution, that is the contribution for 100 units. This is for 100 units. This is for 200 units. Agree? This is for 1 unit. Say 1 unit. Product A. And also you see that here you can get the contribution for 200 units. So what I want to communicate to you is the meaning of contribution. Contribution. And also there is another concept called fixed cost. We call it total fixed cost. Suppose you are selling whatever the item, and you have rented out a particular building. The rent cost is total fixed cost for the month is 60,000. Total cost is 60,000 fixed cost. So what should be the break-even point? What should be the break-even point? Now you see, under 100 units, whether you are making 100 units or not, you have to incur 60,000. Here also your cost is 60,000 because it's fixed. So thereby what happen is, if you operate in this level, 54 would be your loss. Here of course it would be how much? 48. Loss is 48. Agreed? Loss is 48. Loss is 48. So we were talking about break-even point in units. What I want to explain you is the unit contribution. Now in our example, what is the unit contribution? Unit contribution is 60. How do you get the unit contribution? Selling price minus the unit variable cost. So how do you calculate the break-even now? According to our formula, break-even is the 60,000, which is the fixed cost per month, and divide by 60 rupees. What is 60 rupees? The contribution per unit. So thereby, what happened? You have to sell. This is BEP. We call it BEP in units. To make a profit or not situation, profit or loss zero situation, what you have to do is you have to make 1,000 rupees sales of product, 1,000 units. So now we can of course put the 1,000 rupees here, 1,000 units, 1,000 units, huh? So can you get the figures here? 1,000 units. So 1,000 units when you sell, you multiply it by 100 because your selling price is 100. And 1 unit cost will be 40 rupees. So thereby you will end up with total variable cost 40,000. Is it clear? And also the total contribution would be 60. Okay, you can put this is within bracket, within minus, no problem. This is also minus the 60,000, which is fixed cost. So thereby profit would be 0. Yeah. So that's called break even. So what do you call break even? Break even means point at which or the volume at which your profit become uh, 0. Your profit becomes 0. There's a problem in my charger, I think. I have to maintain two things, dongle and the phone charger. That's the problem. I think this is not working. Okay, that is the idea. So what I want to communicate to you is that you will see under 1,000 units, profit is 0, where your break-even point. So thereby we call it at 1,000 units. To make your business profit or no loss situation per month, you have to sell 1,000 units. So thereby, if the business is coming and telling you you have this much of unit sales, Now you see that short term wise the project is not feasible. Why? Their break even point is 1000 units according to the cost structure. Okay, is it clear how to calculate the break even points in units? How do you calculate it? What you have to do is you just divide the fixed cost by unit contribution margin. That's the idea. You just divide it by unit contribution margin. Then the second method of calculating break even is break even point that is true in sales dollar, in sales volume. So thereby fixed cost, you are dividing the fixed cost not by unit contribution margin but by unit contribution margin ratio. So you have to calculate a ratio. So we will do it. How do you calculate the ratio is this way. I think you can remember contribution is 60, selling price is 100. So thereby we call it CS ratio. We call it CS ratio. CS ratio means contribution to sales. Contribution to sales ratio is really calculated based on this way. Contribution, you divide the contribution, you know, unit contribution divide by sales price, SP. Unit contribution is divided by sales price is called into multiplied by 100 because you want it in percentage term. It's called CS ratio. Here it is of course how much? 60 rupees is the contribution per unit and multiplied by divided by 100 rupees and multiplied by 100. That is of course 60%. Okay, so thereby if you want to calculate the what you call the break even in rupees, how do you do it? Fixed cost, that is 60,000, that is the fixed cost, divide by 60%. 60% means 0.6. 60% is 0.6. So thereby you have to have 100,000 sales to get the break even. Just look at this here. Sales unit 1000, break even at sales volume. Volume means here the rupees. 100,000 sales, your break even is 0. So that is about the break even. How to calculate break even in terms of quantity and rupees. Is it clear? Break even point, fixed cost divided by unit contribution margin. Here fixed cost unit contribution margin ratio. How do you calculate the unit contribution? Sales minus variable cost, unit variable cost, you get the contribution margin. When you divide the contribution margin by sales price multiplied by 100, you get the CS ratio or the unit contribution margin ratio. Another name is CS ratio. Now here it is contribution margin ratio. Okay, right, terminology. Contribution margin, variable costing, because always you consider the selling price minus variable cost. That's why variable costing concept is coming. An income statement separates fixed and variable cost and calculate contribution margin, as I did. I calculate the variable cost and I did the fixed cost separately. Total contribution margin, the difference between total sales volume and the total variable cost. I think in our example, we told you the total contribution, the amount available to cover up fixed cost, then contribution to profit. Unit contribution margin, the difference between sales price per unit and the variable price per unit. In our example, here 100 rupees minus 40 rupees. I think total contribution story is very clear from this example. if you are selling 100 units, total contribution is 6,000. Okay, if you are selling 100 units, total contribution is 6,000. If you are selling 200 units, total contribution is 12,000. If you are selling 1,000 units, total contribution is equal to 60,000. So thereby, the contribution is really both for to cover up fixed cost and profit. Now here, your fixed cost is 60,000 and contribution is 6. So thereby your contribution is not enough to cover up the fixed cost. So thereby you are ending up with a 54,000 loss. Here your contribution is 12,000. Your fixed cost is 60,000. You will end up with 48,000. And similarly, here your contribution is 60,000. You will end up with fixed cost of 60,000. So thereby you don't have any profit or loss. That's called break even. So thereby contribution is to cover up your fixed cost and to cover up your profit. So thereby if you make it 2,000, say 2,000 unit sales, what happened?
Profit.
2,000 means double, no? 200,000. Can you understand what I am telling? Make a double one, 8,000, 8,000. But here, even though it is double, your fixed costs remain constant. Even your sales double, fixed costs remain constant. That is one assumption. So thereby you have to put 60,000 only here. 60,000. See here what happened? So you will end up with 20,000. No, I'm sorry. The contribution is different here. No, I'm sorry. Here the contribution is how much contribution? Contribution is double, no, 120. Because we double the sales. Now here the sales is fixed cost is 60,000. That's what I want to communicate to. It won't change. So thereby your profit is 60,000. So you will see when you are making a profit, your contribution contribute to fixed cost as well as profit. So thereby contribution represent two things. What are two things contribution represent? Contribution represent fixed cost and contribution represent profit. Here contribution represent fixed cost but zero profit. Zero profit. Here contribution represent fixed costs minus 60,000 and also loss of 48,000. So thereby contribution represent fixed cost and profit or loss. That's what the slide says here. These 2 points indicate that particular case. Okay, right, shall we go to the next slide? Then of course I did the contribution margin ratio calculation. Unit contribution margin divided by the unit sales price. In our example, you can remember I divide 60 by 100, 60 rupees by 100 rupees because my selling price was 100, contribution per unit was 60. So 60 divided by 100 is the contribution margin percentage. Is it clear? Okay. Then now we will come to the graphical cost volume profit relationship. We can prepare this in a diagram format. We call it the graphical cost volume profit relationship. Of course, we have two axes. Draw the axis of a graph, draw the fixed cost line, draw the total cost line, draw the total revenue line, and break even. Really, there are 5 steps. I'm sorry. One is that draw the axis of the graph. You have to label the graph. Then draw the fixed cost line, draw the total cost line, draw the total revenue line, break even point where the total revenue equal. Yes, total cost. Now you see this one here. Look at this. In this example, you will see Fixed cost is so much. Fixed cost is 374,400. Fixed cost. That is here, you draw a line like fixed cost. And you will see, realize by drawing this line, fixed cost line, wherever the production, whether you whether you produce zero, or whether you produce 200, 2000, whether you produce 4000, whether you produce 6000, whether you produce 800, whether you produce 10,000, the fixed cost remains same. Fixed cost remains same. Okay. Then you will see the total cost line, where you start from the fixed cost. Total cost line goes like this. How do you prepare the total cost? Total cost is variable cost plus fixed cost. Here the fixed cost is 374,400. Variable cost is, of course, 21 per ticket. 21 per ticket. එතකොට ටිකට් 10000ක් වික්කොත් variable cost එක කීයද? ටිකට් 10000ක් වික්කොත් 21කින් වැඩි කරනවා. ඒතර 10000 21කින් වැඩි කරාම කීයද? 2,10,000. නේද? 2,10,000ට එකතු කරනවා මේ 3,71,74,400. එතකොට මෙන්න මෙතෙන්දී හම්බෙනවා what do you call total cost for this line. So thereby what happened here is මේ line එකයි ලා කරලා ඉරාමි. Okay, right. Then it comes to the total revenue. Total revenue start from here, because when you sell 0 point, answer is 0. The one ticket here is given 9,600. 600. Yes, I'm sorry. Tickets 9,600. එතන වෙන 5,766ක් වෙනවා sales. එතකොට ඔබට ticket එක ගන්න බලා ගන්න පුළුවන්. ticket එක ගන්න බලා ගන්න පුළුවන්. ඒ කියන්නේ 5,76,000 බෙදුවතින් 9,600න් ticket එක ගන්න එනවා. එතකොට what I want to communicate to is that you get the line, draw line this, and you get this line, you get this line. This is where your total cost and revenue, match up. So thereby, you will end up with a break even point of this point. So that is about break even point. So this axis, of course, you take the sales volume. Sales volume in number of tickets. 2,000 tickets, 4,000 tickets, 6,000 tickets, 8,000 tickets, 10,000 tickets, 12,000 tickets. And the other axis you get cost, income or cost. Here this axis represent revenue and the cost. If you talk about the revenue, this axis represent revenue. If you talk about the cost, this axis represent the revenue. Okay. Right, that's called graphical method of break even. Cost volume profit graph. Next one is show the total amount of profit and loss at a different sales volume. The graph intercepts the vertical axis at the equal amount equal to the fixed cost. The break-even point is the point at which the total profit or loss line cross the horizontal axis. So thereby, here we are talking about we call it profit volume graph. Here we talk about not the profit volume graph. Here it's a different graph. It's a graphing cost volume profit relationship, break even point chart. Here break-even point chart. So you will see in this graph one unique feature. When you increase sales volume, what happened to the profit? When you increase volume, what happened? Your profit increased by, it's like a shadow of a torch. So when you switch on a torch, when you get far and far, your focus is much more. So it's likewise, uh, here you see the small angle, but here the gap is high when you're going up. Similarly, when you reduce your sales, initially your reduction of loss is small, but when it is somewhere here, uh, you feel that, you know very big reduction in your sales volume, profit volume. Right, coming back to the profit charts, you see here, very simple. Here, this axis represent profit and loss. This is profit, down here loss. So thereby, this part positive, this part negative. And this, of course, we take sales volume in tickets and assume that in this business, 0 tickets being sold. What is the loss? If you are making a 0 ticket uh, being sold, your loss would be equal to fixed cost. Nedi 374 fixed cost එක. ඒ නිසා ඔබ බිඳුවක් වික්කොත්, if you are making 0 tickets, the maximum loss would be the fixed cost. Here the fixed cost point. So you make a star here, and also at break even is 10,000 level, you just draw a line. This is called profit line. So thereby this area indicates profit, this area indicates the loss. This is called profit line, and at this point we call it break even. So that is the profit line or the profit graph. Okay. Then we will discuss another concept, profit, target profit. But before that, I would like to put our attention onto the example what we did here in our example. So shall we just focus on our Excel sheet? There, of course, you may what do you call, you may understand what it is. Now I will just delete all these data. No, yes, this data. What is this fixed cost? No. Okay, shall we make it smaller? Then it's easy for me. Okay. Then you know our basic example. Selling price was 100. Unit variable cost was 40. Contribution is 60. Total fixed cost per month is 60. So if you are selling 10 units, 100 units, these are the data. If you are selling 200 units, these are the data. If you are selling 1,000 units, these are the data. If you are selling 2,000 units, these are the data. So what I will do is basically I will manually construct a chart. So this is my chart, okay, and also I'm doing it manually, okay. අපි chart එකක් අඳින්න දැන්. මේක තමයි chart එක. So this is units. This column says unit, no? This column says what do you call cost and revenue. Agree? We are now just drawing the chart. I would say I take this is here I take 1000 units. I have take little bit more. 500 here 1000 units. Here 1500 units. Okay, and maximum income you see, you can put even if you can draw this little bit more if you want. You can put 2000 even, no problem. For 2000, of course, you see maximum sale is 200. The maximum here 200. Okay, so what අපට මෙතන කොහොමද දාගන්න පුළුවන් 500 කරගන්න 510 1500 දෙකක් විතර වුණා තමයි අපිට බලුවන් මේක කරගෙන දාගන්න right දැන් බලමු අපිට 500 ගානේ දාගන්න පුළුවන් කියලා අපි හිතමු මේක රුපියල් 500යි 500 නෙමෙයි එතන එන්න ඕන 2 ලක්ෂයක් නේ 50000ක් විතරයි 50000යි දෙවෙනි එක ලක්ෂයයි නේද 1,50,000යි නේද මම 2 ලක්ෂය okay 50,000යි ලක්ෂයයි 1,50,000යි 2 ලක්ෂය මෙතන ඉවරයි මම හිතන්නේ so what happened? What is the fixed cost? Fixed cost is 60,000. So 60,000 කියන එකට අපිට chart එකක් ගහගන්න නේද? We may insert 60,000. Here. 50 වලට වඩා පොඩ්ඩක් උඩින් අපි අඳගමු. 60,000. That is the fixed cost we label as TFC. What is TFC? TFC is the total fixed cost. What is the total revenue? But once you decide this maximum points, you know, according to this chart, maximum is 200. So thereby, if you want, you can complete this something like this also. I think that is easy. මෙහෙම අඳගත්තා නම් easy. chart එක හරියටම අඳගත්තා. සීමා ටික ලකුණු කරගත්තා නම් මේ විදියට පොඩි කොටුවක් ගහගත්තා නම් very easy. එතන අපි දන්නවා sales අපි ඊළඟට හඳුනමු sales revenue curve එක revenue column එක අඳිනකොට අපි දන්නවා revenue column එක බිඳුවේදී බිඳුවයි මෙතන but when you are making 2000 sales, what is your sales income? 2000 units කරනකොට sales income එක එනවා 2 ලක්ෂයක්. එහෙනම් මෙතන ඊළඟ point එක. ඒතරත් මොකද කරන්නේ? ටක් ගාලා ප්‍රස්ථාරය හරි ලේසි අඳින්න. අඩිරූද අරගෙන මෙන්න මේ point එක යා කරන maximum that's all. That is TR. Huh? That is our TR. What is TR? Total revenue. TR means total revenue. Then we have to draw the total cost. How do you get the total cost? Total cost is variable cost plus the fixed cost. Now, for example, here total cost penne ape total cost is basically under this CVP analysis. Total variable cost total variable cost, right, plus the TFC. TFC කියලා කියන්නේ total fixed cost. Total variable cost will vary from level to level. Yeah. එතන අපි ගන්නවා total cost at 0 point. 0 එකේදී කීයද? බිඳුවක් එක්කොත් total cost එකේදී ඇත්තටම total cost එක කීයද? Variable cost එකද කීයද? If you are selling 0, if you are selling 0, variable cost is 0. But at a 0, you have a fixed cost, that is 60,000. එතකොට total cost එක කීයද? 60,000. අපිට points දෙකක් හොයාගන්න ඕන since these are lines are linear. අපි ඊළඟ 2000 වලදී බලනවා කොහොමද කියලා. 2000 වලදී variable cost එක එකක් වුණා 40ක්. එහෙනම් 80,000 නේ variable cost එක. We know that TFC is remaining constant, that is 60,000. So thereby variable cost plus fixed cost would be 140. So thereby බිඳුවේදී total cost එක 60යි, which is from here. And if you are selling 2,000, not the 20,000, 2,000, your contribution, your variable cost would be 80,000 and fixed cost would be 140,000. Sorry, 60,000. Total cost would be 140,000. එතකොට අපි බලනවා ඒ 2000 දී 1,40,000 කොහෙද තියෙන්නේ කියලා. ඒක මාක් කරගන්න. ඒතර ඒක මාක් කරගන්න මම හිතන්නේ ඒක තියෙන්නේ මෙතන 1.50ක් නේ. මේකට පොඩ්ඩක් යටින්. නිසා අපි මේකට පොඩ්ඩක් යටින් කර්ව් එක ගෙනෙත් තියෙනවා. අපි අඳින්නේ කොහොමද? පටන් ගන්නවා මෙතනින් නේද? මෙතනින් පටන් අරගෙන මෙන්න මේකට පොඩ්ඩක් යටින් 1.40ක් නේ ඕනේ. ඔන්න හරියෙන් අපි ගෙනෙත් නේද? එතකොට හරියට මේක ඇඳා නම් අපේ මේ break even එක මම හිතනවා පොඩ්ඩක් පල්ලෙහාට ගෙනාවා නම් අපිට හරියට ඇඳ ගන්න පුළුවන්. අන්නවම ගෙනාවා නම්. So our break even is 1000 here. Can you remember? This is called break even chart. So this segment, this angle represent the profit, this segment represent the loss. Is it clear? Okay, right. Then we will draw the what you call the profit chart. Profit chart is very simple. Profit chart is you should have only it's something like this. You have a line here, right, and also line. Sorry. Another line here. Okay. So this is 2,000 unit sales. All right. This is 2,000 unit sales. Likewise, you can have it's 500. 500 sales. 1,000 sales and 1,500 sales. Likewise, you can have it, no problem. Okay, 200 sales is here. You can here it's a 0, of course. You can remember it's a 0 here. When 0 here minus the maximum is what is the profit is 60 years. අපි ගමු 30,000 කියලා එකක්. දැන් failed එකක් 30,000. Here 60. 60,000. That is the loss. Here also we take that is 30,000, and here is 60,000. About a method 60,000. Okay, according to our data, maximum, minimum, no minus, no loss. So what you can do is, if you are making, then it's about to make a theory. කරාට පස්සේ මෙතන මම පේලි දෙක ගත්තේ. ඒතකොට අපිට ටක් ගාලා මේක මේ වහ ගන්න පුළුවන්. ඒතර හරි ලේසි එක කරගත්තාම ඒතර අඳින්න ලේසි මේ chart. right? ඒක වහන්නේ කොහොමද? මෙතනින් අපි ඉරක් ගහලා මේ පැත්තට මේක අරන් යනවා. right? තරින් ඉවරයි ඒක. ඊට පස්සේ මේක මේ පැත්තට ගේනවා. chart එක manual අඳින හැටි මම මේ කියන්නේ. මේ පැත්තට ගේනවා. That is the limits, the boundary. එතන profit chart එක අඳින්නේ හරිය ලේසි boundary තීරණය කරගත්තට පස්සේ profit chart කියලා කියන්නේ මොකුත් නෙමෙයි. මෙතෙන් නම් මෙතෙන්ට ගන්න එක. හරියට වැන්දනම් theoretically මෙතන හරියටම cost වෙන්න ඕන 1000 එකේදී break even. මේ ටික profit මේ ටික මේ line එකට කියනවා profit chart profit line. Is it clear? How to draw profit line and this graph? Very simple. If you know the maximum profit in our chart, maximum අපි 200 ගත්ත නිසා maximum profit is 60. මම 60 ගත්තා. The maximum loss is zero sales. එතකොට fixed cost එකට සමාන වෙනවා. ඒ විදිහට හඳගත්තා. Right. Shall we go to the next one? Or shall we have a break? What is the time? Yeah. Shall we have a small break? 15 minutes break. We'll come back 3:40. I just want to answer a few questions. Assignment, do we need to do? Oh yes, you have to do all the question whether we did in the class or not, including if we have already done 7th rule should apply. 7th rule is applied where you have a question whether how long will it take to double your investment. When the interest rate is given, you can apply 7th rule. So can you please do the cost of capital past? Yeah, I will do the cost of past paper questions under revision class. Sir, mortgage. So for mortgage calculation, is there a specific formula? And that exam are the formulas in time values lesson given. At the exam, you will be given a what do you call? You will be given a table. Based on table, you have to find out the factor and multiply it and get the answer. No formula, but on top of each and every table, on top of each table, you get the formula. You will get the table. The 15, the investment row, do we have to consider as a cash? Yes. What I did was initial investment 200. That is outflow, but at the end of the project, you will sell your investment. You will convert your project by selling 50. The residual value is 50. That's the idea. Residual value is 50. That's why I put here 50 because it's a coming in. It's a cash inflow. When you are making, suppose you are buying a car. When you are buying a car, you have to incur an outflow. Now, if you are selling it after 2-3 years, you will get the cash inflow. Similarly, maybe you may in a position to sell more than the investment. Maybe you are selling you may be in a position to sell it at very lower rate, or as it is, whatever, depending on the market for the project, depending on the market for the item what you are talking. So residual value is different. 50 rupees. Or 50 billion in our investment analysis question, the Excel sheet was basically the residual value after. Yeah, Ratnatunga, if you have any question, you can ask, no problem. If you want to raise any question, no problem, you can ask.
Hello.
Yes, you can ask.
The 15, the cash inflow, what you just mentioned, we didn't consider for that tax purposes. Do we have to consider that as a cash inflow for tax?
You mean the Excel sheet what we discussed under the capital budgeting?
Yes, yes.
Here, I'm just sharing it. See whether you can see it. What is your question?
The number four, fourth year 50 billion, the investment row, which you are getting a cash inflow of 50.
It's 50.
Yeah, that's one.
Yeah.
Do we have to consider that for
Uh,
this cash inflow tax?
it's a good question. Um, uh, so answer is like this. Now there is now of course we have to calculate whether there is a capital gain or not. Whether there is a capital gain or not. If there is a capital gain or loss, then we have to look at whether in the particular country's tax law, whether they are charging a tax on capital gain. If there is a law of charging tax on capital gain, of course you have to tax it. Otherwise, no. But I assume normally in Sri Lanka, according to my understanding, especially when you do trading transaction in the stock market, suppose you yesterday buy a one share at 100 rupees, today you are selling it at 120. So thereby you see in this transaction there is a 20 rupees profit because yesterday you bought at 100 and today you are selling it at 120. So there is a capital gain of 20 rupees. But you know, in the Colombo Stock Exchange transaction, just to encourage the transaction, just to encourage the trading, those capital gains are exempted, no tax on capital gain. So what I did was I assumed that there is no tax on capital gain for this project. That's why I didn't tax it. Otherwise, you have to calculate the capital gain according to tax law, not according to the accountant law. Accounting. There is a way, but I don't have time to explain you how to calculate the capital gain for properties like machinery and other things. But of course, for the share market, selling shares very simple. Buying price and the selling price difference is the capital gain. But of course, for other tax allowances where you can claim capital allowances, for that of course there is a way of calculating. There is a technical way of calculating capital allowances. But for the time being, you just ignore the tax on capital gain. Any other question? Okay, right. Then I hope that my point is very clear, and I was really answering for the questions you raised. Is the assignment first part done in the class? Should we include that part? Yeah, whatever the tutorial questions which is appeared in the tutorial, you have to answer whether we did it or not in the class. There is no residual value. Do we have to take it to present value? Yes, we have to. Residual value we have to convert into present value. That's what we did in the question. Any question, Piyumanda, Ranasingh? I think he. Anyway, if you want, you can talk. No problem. I can. If you have any question, always you can raise or you can ask or you can disturb me. You can. You can really. Lab එකේ පොඩි අවුලක් තියෙනවා. Yeah, it's appeared here is in a different way. No? Actually, but anyway, we'll ignore it. No? Okay, right. Any question? Right. Shall we come to the rest part of the our okay. We will come to the balance part of the today's lecture. There we stop. We studied how to calculate break even. We studied how to calculate break even in rupees, break even in volumes. Now what we do is we will go to the next one. Next one is this, yes. But there was one question. This is the profit graph, that is true. This is called, you can label it as break even chart or the cost volume profit chart, doesn't matter, whatever the chart. This is break even chart, you can say break even chart, no problem. Here cost volume profit graph, here the cost volume profit chart, break even chart, whatever the name, no problem. Okay, we'll come to the target profit. Now suppose you want to plan particular sales level, you want to achieve to get that particular profit. So if that is the case, what you have to do is you just add the profit, expected profit, to the fixed cost and divide by contribution margin. You get the answer. For example, in our scenario, suppose you know basic information, you are very clear about the basic information: sales price, unit variable, contribution, fixed cost. Suppose you do want to get a 100 rupees profit. So how do you do 100 rupees profit? 60,000, which is fixed cost, plus the profit you required, that is say 100,000 rupees profit you need. And these two figures, you have to get the total and divide it by what? Divide it by unit contribution. Unit contribution is 60. You get the answer. Unit contribution is 60. So with that, of course, you see that the profit, to earn that much of profit, your sales has to be this much. Suppose your idea is not that you want to make 120,000 profit, then this figure has to be 120,000. See, 120,000. For 120,000 nothing, but 3,000. So we know that by under this cost structure, under this selling price structure, if you want to make 120,000 profit from the product A, our target has to be to sell 3,000 units. Just see 3,000 units. Once you put 3,000 units, what happens? 3,000 units. Can you help me the columns to prepare the columns? Sales price, how much? 100 minus 100 multiplied by 3,000, that is 300,000. What is here? Unit variable cost or the variable total variable cost. 1 unit is 40. You are selling 3,000. So thereby 120,000 is the variable cost. And you know this is a minus figure. Of course, you have to be very clear because it's expense. So you can get the difference. Of course, here you see you can get the, oh my god, no, this plus, no, this plus this. Of course, you know the answer, 180,000. Here, of course, 60,000 is the fixed cost. Fixed cost remain constant. So thereby, what happened? Profit would be the balance. Then profit would be really profit would be not 108,000. Profit would be how much? This plus this, no? So what 120 no, ne? That is profit. No, me ape chart එක ඉතින් මම cost වලින් මෙතන එන්න ඕන answer එක මොකද? Profit. නේද? That's the profit. So that is 100. So if you want to have a target profit, the formula would be very basically fixed cost divided by target profit into unit contribution. So you can, you know, the target sales to achieve that much of profit. So if you are a, you know, if your boss is telling, okay, this time you have to make 120,000 profit. If you made 1,020 rupees, 1,020 rupees, 1,020,000, 1,020,000 profit, I will give you a bonus. Then as a sales rep, you know your sales target is 3,000. Sales target is 3,000. Okay, right. Then we'll come to that next one. This is another formula, formula 3, as per our slides. But you can develop different formula, don't worry. Based on these textbooks, the formulas are this. If you refer to some other text, some other author, you may get a different type of formula. Don't worry about that. Using Cvp analysis, management decision making. First one is safety margin. Difference between the budgeted sales revenue and the break-even sales revenue. Given a feel of how close projected operations are to the break-even. Changes in fixed cost, we will discuss that part separately. So next point which I want to highlight you is that margin of safety. What do you mean by margin? What do you mean by margin of safety? What is the meaning of margin of safety is the question. Now you know unit contribution. You know CS ratio, the unit margin contribution ratio. You know how to calculate the break even. You know how to calculate the unit to be sold when you are expecting a particular level of profit figure. That of course we have calculated. Now we are talking about safety margin. Safety margin is the difference between budgeted sales revenue and the break-even sales. Because here why it is budgeted sales, when you make decisions, you are not taking, of course you use actual data when you are doing the control, but if you are going to take future decisions, always you forecast the future. Budgeted sales you have, and you have the break-even sales. Suppose in our example, right, budgeted sales volume is 1,120, 1,200. 1,200. Okay, you got my point. I'm just taking this just to, you know, communicate one more thing, but I can take even 2,000 units or no problem. Now I put budgeted units in red or whatever the different color. These are budgeted figures. So make a selling price එක selling price එක 100 නම් මෙතන එනවා 1,20,000. හරිද? එතකොට selling price එක එච්චරයි 1,1200ට 40 ගානේ 8යි 4 2 8යි 4 4 නේ 48000. Is it clear? 48,000, right? Which is a minus record, minus figure because it's expense no minus කියලා දැම්මම ලේසියිනේ මට. එතකොට මේ දෙකේ එකතුව නේ. එහෙම නේද? contribution එක වෙන්නේ total contribution. Total contribution is that. So the profit figure is TFC is 60,000. Okay. So thereby the profit is 12,000. Agree? I just put that column also. Now, what is the meaning of margin of safety? So margin of safety is කෙටියෙන් කියන්නේ MOS. What is margin of safety? MOS කියලා කියන්නේ margins. Margin of safety is equal budgeted sales, that is BS, minus break-even sales. Budgeted sales minus break-even sales. Budgeted sales in this example is 1,200. Okay. Break-even sales is in this example 1,000. So thereby margin of safety is 200 units. Margin of safety is 200 units. Okay. If our budgeted sales, if assume that budget sales I am telling you 2,000. There 2,000 වල මොකද කරන්නේ? 2,000 වලින් අඩු කරනවා 1,000. එතන margin of safety කීයද? 1000 if that is the case. But I am in this particular scenario. Are you clear? 200. So that is called margin of safety. But you can express the margin of safety as a percentage also, even if it is not in the slide presentation. But how do you calculate the margin of safety in percentage? That is basically MOS. MOS means margin of safety in units. Margin of safety in units divided by budgeted sales. Budgeted sales. BS. What is our case here? Margin of safety in our case we have already calculated 200, and budgeted sales in our case how much? 1,200. So to make it meaningful we are multiplying by 100. 16%. Margin of safety is 16%. Okay, but here what is the margin of safety in percentage? In rupee wise, in quantity wise 1,000. Margin of safety, if that is the case, 1,000 divided by 2,000, because budgeted sales into 100, you know, it is 50%. So you see the difference. Margin of safety here is 16% if budgeted sales 1,200. If budgeted sales 2,000, margin of safety is 50%. So meaning of what do you call meaning of the budgeted sales is that meaning of margin of safety, that now you see you assume that you are in this case. Margin of safety means if your sales decrease by a particular percentage, what would happen to the break even? What would happen to the profit? That is the answer. So thereby margin of safety measures the sensitivity of your operation. Margin of safety measures the sensitivity of your operation. That is the point which I want to highlight. Margin of safety measures the sensitivity of your operation. Here, if your sales drop by, now you know budgeted sales. So we expect so much of sales, 1200. If your budgeted sales figure dropped by 16%, what happened to the business? You reach the break even. That is the meaning. But if your sales drop by more than 16%, say 20%, what happened to you? Due to unavoidable environmental circumstances, that is true, you plan to have 1200 sales unit, but due to environmental uncertainty, your sales budgeted figure drops by 20%, then you will end up with a loss because your margin of safety 16%. So thereby this percentage, lower the percentage, higher the sensitivity. Lower the percentage, higher the sensitivity. But in this case, you see 50%. That means if budgeted sales drop by more than 50%, then only you are making loss. Up to that you can tolerate. So thereby margin of safety indicates your tolerance range, your tolerance level, your sensitivity. Lower the rates, lower the margin of safety ratio, higher the sensitivity towards the sales drop. Sales drop. So why sales drop? What are the reasons for sales drop? Sales drop means your cake is really acquired by someone else. So you are not in a position to face the competition. You are weak in the competition. You are weak in the playground. You are weak in the competitive playground. That's why your sales is dropping. Your maybe product outdated. Maybe new competitor is entering into the business and capture the market. Maybe your sales force is not providing appropriate relevant customer service. Maybe customer is dissatisfied. Maybe price is high. There are so many reasons for your sales drop. So thereby what I'm trying to say is that if you calculate the margin of safety for your business, meaning is that it indicates the degree of sensitivity towards the competition. Lower the ratio, higher the sensitivity. But I think you can remember, this is a classic example. Airtel enters into this industry about 7-10 years back. I don't know whether Airtel is operating now, but when they enter, what happened? What they did? Other telecommunication service providers, their sensitivity, their margin of safety was very low. So they make SIM card freely. I think I can remember it is a lot or some those days. So thereby, when a new competitor enter, or when a competitor is changing strategies, your close competitor changing strategies, or when newcomer is coming up, this margin of safety is important for us. If the margin of safety is 50%, 60%, that means market leader. We are a market leader. So thereby, when newcomer is coming into the place, competition, we don't compare, we don't consider, we ignore it. It's a simple matter. But when margin of safety is very low, then we are much more sensitive to the competitors. අලුතෙන් එක්කෙනෙක් එනකොට ගහලා මුලින්ම අයින් කරලා දාන්න බලන්න. That's the strategy. But if your margin of safety is high, we are strong, we have the leadership, market leadership, our margin of safety is tolerance rate is very high, then who cares? No problem. Okay, that's the general trend. But I'm not saying that even when newcomer is coming into the play, you have to be aware. Your intelligence service has to be capture the data. That's a different story. But based on margin of safety, you may take short-term decisions whether to react for the competitors or whether not to react for the competitors. I think you got the margin of safety. How do you calculate the margin of safety? As per our slides, budgeted sales divided by break-even sales. They come a BS, budgeted sales divided by BS sales, break-even sales. Of course, if you want, you can put BE, capital E, break-even. Budgeted sales, break-even sales, and if to make it meaningful, you can calculate a percentage. It's not in our slide presentation. What you can do is margin of safety, a margin of safety in units, or the MOS in units divided by budgeted sales. When you multiply it by 100, you get a percentage. That's what margin of safety. So thereby margin of safety provides a very very good insight for you to take decision towards about the competition, whether to take it seriously or not to take it seriously. Okay, right. Changes in fixed cost. Percentage change in fixed cost will lead to a similar increase in break-even point. Different fixed costs may apply to different level of sales production volume and provide more than one break-even. But here its idea here is, now what happened, our break-even point increased by break-even point increased by 80,000, not 60,000. So all total figures change, no? Here it's 80,000 you put, you see, it will have an impact on profit. It will have an impact on profit. It will have an impact on break-even also. So thereby, we are much more sensitive to the fixed cost also. Fixed cost is very important for an organization. Fixed cost is very important. Now I'll take that one also. Now, if you look at this particular example, our fixed cost was 60,000. Can you remember our example? 60,000. You know, it is at zero level 60,000 because your rent cost, whether you open the shop or not, you have to pay the rent per month, 60,000. And when you made 500 sales units, your fixed cost 60,000. Agreed? 60,000. When you made 1,000 units, again your fixed cost is 60,000. Previous example, huh? When you make 1,500 units, fixed cost is 60,000. Okay. When you make 2,000 units, your fixed cost is 60,000. That is the meaning of fixed cost. Fixed cost which is remain irrespective of the level of production is called fixed cost. So thereby, what would be the unit fixed cost? We call it UFC, unit fixed cost. In this case, unit fixed cost is this divided by this. Unit cost is 120. You see what happened to the unit cost? මෙතන data නැති නිසා එන්නේ මම data දැම්මේ නැත්තේ පොඩි කතාවක් තරක් අදහසක් දෙන්න. 500, when you are making 500 units, unit fixed cost is 120. When you are making 1,000 units, unit fixed cost is 60. When you are making 1,500, is unit cost is 40. When you are making 2,000 units, unit cost is 30. So thereby, what is your conclusion? When your fixed cost is high, better to sell more and more units. When you sell more and more units, unit fixed cost is reducing. That's why you are getting higher profit here. Now here you see the profit. If you look at my chart, break-even chart, you can understand. Here, you see this level low profit, this level high. But in same year, when you reduce the level of sales unit, your loss become more and more. That is because of this particular behavior of unit fixed cost. When you sell more and more, your fixed cost remain fixed cost, unit fixed cost getting low and low. Classic example, think about the private buses. Why private bus people are really අපි කියන්නේ කොට කොට යන්නේ? Why they are attacking the people? Simple answer is that. Suppose you are running public transport from Peta to Anuradhapura, or whatever the distance. Your diesel cost and driver's cost may be certain cases. Driver take a turn එකකට ගෙවනවා නම්, conductor එක turn එකකට ගෙවනවා. Those costs are fixed. එතන මුදලාලි මොකද කියන්නේ? Suppose your diesel cost for that tour is 1,000 rupees for the public transport, one turn, just to go from Peta to say Maharagam. 1,000 rupees diesel cost. 0 passengers. What you have to do? Driver kondastara idara bus එකේ ඉන්නේ Peta ඉඳන් Maharagam. What happened? You will end up with a diesel cost of 1,000. එක්කෙනෙක් දාන්නේ. What will happen? You will end up with a 1,000 unit cost of 1,000. The ticket එකට රුපියල් 100ක් හරි 50ක් හරි 60ක් හරි දීලා ආවම ටිකට් ආදායම රුපියල් 30ක් යනවා. diesel cost එක 1000ක් යනවා. What happened? 10 දෙනෙක් ගෙනාවම your diesel cost per passenger would be 100 rupees. What happened? 100 ගෙනාවනම් බස් එක your diesel cost would be 10. So that's why people, when fixed cost is important, when fixed cost is significant, the behavior of the people or behavior of the managers to get the maximum benefit, to have the maximum capacity. That is the case. So thereby, they do that way. Thereby, they have the maximum capacity. They have the maximum capacity. They are trying to use the maximum capacity. Are you clear? Are you clear? Yes. So when you take hotels, airlines, IT providers, telecommunication businesses, all these businesses, if you see, their fixed costs are very high. Therefore, when they get more customers, they are more profitable. Like our chart. When they get more customers, instead of 10,000 customers, if they are getting 12,000, they are more profitable. But if their customers reduce to 4,000, what happen is they are having a loss. That is the important point. Okay, that is the important point.